Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section E3, and this is an application topic. Calculate the carrying amount of equity method investments and prepare journal entries excluding impairment. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out and sign up for our free 1-hour webinar where we go over the key ingredients to passing the CPA exam. Again, it's only 1 hour and it's free, and we will show you how to be effective and efficient with your studying, even in just that 1 hour, but you'll probably want to learn more after that. And one thing that you'll probably want to learn about is our Pro Bundle. Now, just letting you know that SuperfastCPA Pro members have access to our full 10-question video versions of these 5-question YouTube videos. We're only going to be going over 5 questions today, but again, SuperfastCPA Pro members get access to the full videos where usually we go over 10 questions. So if you like this, if you like the webinar, if you like our other products, make sure you become a SuperfastCPA Pro member and you will get access to a lot of great resources, again, including these full version videos. With all that said, let's dive straight into the questions. All right, here we are at question 1, and one thing we always like to point out is it's a good idea to read the last part of the question first so that you can have context for the rest of the question. You know, it doesn't always help, but it is a great habit to be in, especially for test day, because it will help you get through questions more quickly and understand what they're asking more quickly. So let's read the last part here. What is Jones Inc.'s percentage ownership in Harper Corp., and should Jones Inc. use the equity method to account for its investment? Okay, let's go up to the top. Jones Inc. purchased voting shares in Harper Corp. For $487,500. At the time of the purchase, the total voting shares of Harper Corp. Were valued at $1,935,000. Based on this investment, again, what is their percentage ownership and should they use the equity method? Now, if you have no idea what the equity method is, this is the right video. We're going to learn about what it is and especially how to calculate carrying amounts and things like that. But right now, we're focusing on when you even use the equity method. So if you don't know the rules for that, we're going to look at the answer and figure it out together. If you know how to do this, then that's great. You probably already know the answer. Let's go ahead and look at this to kind of learn what we're dealing with for the rest of this video. All right, here we are. The answer is B. They would have a 25.2% ownership percentage, and that means that, yes, they would use the equity method. So to calculate the ownership percentage is pretty easy. I mean, you probably already did this part yourself. You just weren't sure necessarily what the equity method was. $487,500 divided by $1,935,000 is 0.2519, or really 25.2%. So what does that mean? As a general rule, the equity method is used when the investor has significant influence, typically indicated by ownership of 20% to 50% of the voting shares. Since Jones Inc. owns 25.2% of Harper Corp.'s voting shares, it is presumed to have significant influence, and therefore the equity method should be used to account for this investment. So the first thing we're learning is that to use the equity method with an investment, you want to have ownership of between 20 and 50%. That's pretty much all we're given in this question, though. So let's take that and go to the next question to kind of build on this idea of significant influence. All right, here we are at question 2. Let's read the last part. Which accounting method should Arbor Inc. use for its investment in Birchwood Ltd? So it's asking what method we're supposed to be using. Probably the equity method, but let's read through this to kind of get an idea of why we should be using the equity method. Arbor Inc. purchased a 15% ownership stake in Birchwood Ltd. for $450,000. The following factors characterize the relationship between Arbor Inc. and Birchwood Ltd. Arbor Inc. is the primary supplier of raw materials to Birchwood Ltd. Arbor Inc. has a contractual agreement allowing it to appoint 3 of Birchwood Ltd.'s 10 board members, so that's 30% of the board members. Arbor Inc. regularly participates in policymaking processes for Birchwood Ltd., including decisions on major business strategies. So again, with all that information, they have a 15% ownership, but they have all these other things that they're doing with Birchwood. Does that mean that they have significant influence? And does that mean that we would use the equity method? You know, probably, but let's read through these other ideas. Use the cost method because it owns less than 20%. You know, maybe, because so far all we know is that it's between 20 and 50%. That's when you use the equity method. Use the equity method as the relationship suggests significant influence over Birchwood Ltd.'s operations. So because of the relationship, maybe they do have significant influence. You could use the fair value method because it doesn't have majority ownership. So, you know, instead of the cost method, it has the fair value method, maybe. Or you could use the consolidation method. Probably not consolidation because, you know, if you know anything about consolidation, you have to own a lot of a company to have it be consolidated. So that's probably not the right answer. Again, we're dealing with the equity method in this video, so you can probably guess it's the equity method. But I kind of wanted to walk through that thought process to kind of show you how you want to be approaching these questions. With that information that we have though, and with that thought, let's go to the answer to kind of learn what we're doing here. All right, here we are. The answer is B. Yes, you would use the equity method. That's probably pretty easy to guess, as the relationship suggests influence over Birchwood Ltd's operations. So the idea behind this question wasn't to be like, oh, is it the equity method? It was more to show you that there are situations where you can have significant influence, even if you don't have that 20 to 50% ownership, and therefore you can still use the equity method. So let's walk through this. The equity method is appropriate when an investor has significant influence over an investee. So overall, the idea here is not just this 20% or 50% ownership rule, it is significant influence. That's what you want to be looking for. Of course, 20 to 50% is kind of usually an indicator, but that's not the only reason. In this scenario, Arbor Inc.'s ability to appoint board members, its role as a key supplier, and its involvement in policymaking suggest a significant influence over Birchwood Ltd. So with all these things, if they have a really big impact on Birchwood, even though they only own 15%, but they are making, they're making policies with them, they're appointing board members, they're doing all these things, then that's kind of an indication that they do have significant influence, and therefore you would probably use the equity method. These factors indicate that Arbor Inc. should use the equity method. Again, so we walked through all that. Again, the percentage ownership alone is not the only reason you would have significant influence. The fair value method, you probably wouldn't be using that because that's typically for passive investments, not like where you have a whole bunch of ownership, but more just you're getting little bits of money. That's where you're calculating things at fair value. And then, of course, like I mentioned, the consolidation method, that's for if you own more than 50%, that's when you own a lot of a company. So that's the equity method. We've talked about it, how you know that you're supposed to use the equity method in the first two questions. Now that we've built that understanding, we're going to go to the next three questions and see what that even means. How do we use the equity method to calculate the carrying amount of investments? So let's go to question 3. All right, here we are at question 3. What is the carrying amount of Cedar Inc.'s investment in Oak Ltd. at the end of year 1? So now we're finally figuring out the carrying amount now that we understand when you're supposed to use the equity method. On January 1st, year 1, Cedar Inc. purchased shares in Oak Ltd., resulting in an initial investment of $480,000, which gave Cedar Inc. a 30% ownership stake. During year 1, Cedar Inc.'s share of Oak Ltd.'s net income was $30,000, and its share of dividends received was $3,000. So with all that information, we have to figure out what the carrying amount of the investment is. Now, just based off of the idea behind this question, you could probably figure it out even though we haven't done this yet, because frankly, this question is quite simple to kind of, again, build into understanding how this is supposed to be done. If you want, go ahead and pause the video and try this on your own. If not, we're going to go ahead and look at the answer to learn how you start calculating the carrying amount when it comes to the equity method investments. All right, here we are. The answer is A, $507,000 is the carrying amount in this situation. Now again, this question is pretty simple. It wasn't meant to be difficult because I'm trying to show you how this works, and then in the next question, we're going to have a little bit more difficulty. But really the idea here is all you have to do is figure out their share of the net income, their share of the dividends, and that affects the carrying amount. And in the next question, we're going to have to actually do some deeper calculations to figure that out. But that's really the idea. You take the initial investment, you add their share of net income, which is $30,000 in this case. Luckily, we were given that. So that's $510,000 after adding that. And then they had a share of dividends, which actually does decrease their carrying amount. So 510 less 3,000 is $507,000. Again, pretty easy. All you have to know is that, yes, they are using the equity method, and therefore they get a share of the net income and or the net loss, potentially. And they also have the share of dividends that is going to decrease their carrying amount. So that's the basic idea behind that calculation. Again, let's go to question 4, and we're going to learn a little bit more about this, a little bit more complexity. All right, here we are at question 4. What is the carrying amount of Elm Inc.'s investment in Spruce Ltd. at the end of year 2? Okay, so that's good information. Let's go to the top. On March 1st, year 1, Elm Inc. purchased 18,000 shares of Spruce Ltd. at a price of $30 per share. This purchase gave Elm Inc. a 36% ownership stake in Spruce Ltd. Spruce Ltd. reported net income of $150,000 for year 1, evenly earned throughout the year, and paid dividends of $20,000 on December 31st, year 1. In year 2, Spruce Ltd. reported a net loss of $50,000 and paid dividends of $10,000 on December 31st, year 2. So with all that information, again, we have to figure out what the carrying amount is at the end of year 2. Now, just based off of the previous question, question 3, we already got the main idea of how you're supposed to do that, but it was a lot easier. Most of it was given to us. In this situation, we have to figure out what the original investment was. We have to figure out what their portion of the net income is. We have to figure out what the portion of the dividends is. There's a few things we have to actually figure out. So I think you should pause the video, try this calculation on your own, because again, based off of question 3, I think you could probably do most of this. So try it on your own, and when you're ready, come back, we'll look at it together. All right, here we are. The answer is D. $556,200 is the carrying amount of their investment at the end of year 2. So let's walk through this. Again, it's not too difficult once you understand what it's asking, which really is just figuring out the share of the income or the loss and figuring out the share of the dividends. So let's go into it. The initial investment, and you had to calculate this, was 18,000 shares at $30 each. So that would be $540,000 of the initial investment. Now to figure out the year 1 impact on the carrying amount, we have to figure out their share of the net income and their share of the dividends. For the year 1 net income, remember they purchased this in March. So they only had an investment in this company for 10 out of the 12 months. So $150,000, which was the net income that was given for year 1, multiply that by 10 out of 12 months, and then you multiply it by the share that they had, which that was given to us luckily, so 36%. So multiply that all together, and that means that their share of the net income is $45,000. So we're going to be adding that to the investment, but then there is the dividends that they also received as well. Their share of the dividends was just the 36% of the $20,000 of dividends. And the reason that this one doesn't really take into account the 10 out of 12 months is because dividends are usually given at the end of the year anyway. So it's just given based off of the percentages at that time. Whereas with the net income, that's affected by how long they had the investment, because if the income was kind of gained fairly evenly throughout the year, that means that there's 2 months of the year where that net income definitely wouldn't have been attributed to the investor. So with all that, again, we take the initial investment, we add the net income, their share of the net income, and we subtract their share of the dividends, and that gives us $577,800 as the carrying amount of the investment at the end of year 1. Now we can carry that into year 2. Similar idea, but they had ownership all the way through year 2, so we don't have to figure out, 10 out of 12 months or anything like that. We can just do $50,000 of this loss multiplied by their 36% ownership, and that gives us an $18,000 share of again, it was a net loss. So remember that this is a loss. And then the dividend share is, again, just $10,000 multiplied by their 36% ownership, so $3,600. So you take this investment from year 1, subtract the net loss, their share of the net loss, and subtract their share of the dividends, and that gives us $556,200 as the carrying amount at the end of year 2. Again, this is something that's not too difficult once you've seen how to do it. So now that you know how to do it, I don't think it'll be too much of an issue if you see this on the exam. But that's pretty much what you need to know for figuring out the carrying amount of investments under the equity method. There is going to be one more question that I'm going to go over where we're going to talk about income under the equity method. Again, I know that's not the blueprint topic that we're going over, but it does seem like this is something that you could be tested on when it comes to the equity method. So let's go ahead and go to question 5 to talk about that a little bit. All right, here we are at question 5. Like I said, this is actually not to do with the carrying amount. It's to do with the income under the equity method, but it does seem like this is something you should know. So let's talk about this. What amount of income should Oak Corp recognize from its investment in Maple Inc. for year 1? On January 1st, year 1, Oak Corp purchased a 10% ownership stake in the common shares of Maple Inc. for $500,000 and a 30% ownership stake in the preferred shares of Maple Inc. for $300,000. This investment allows Oak Corp to exercise significant influence over Maple Inc. During year 1, Maple Inc. reported the following: net income of $400,000, preferred dividends declared and paid totaling $93,500. What amount of income should Oak Corp recognize from its investment in Maple Corp for year 1? Okay, so we have this information. We have to figure out how they are going to recognize income. This is different than what we've talked about so far. So if you have no idea, that's okay. If you have a guess, go ahead and pause the video and try this on your own. And after you're done that, we're going to look at the answer to see how the income is calculated when you know their preferred shares and their common shares and things like that. So again, try this on your own if you want and come back when you're ready. All right, here we are at the answer. The answer is C. $58,700 is the amount of revenue that they're going to recognize from this. So let's walk through this. It's not too difficult once you, again, see how it's done. So to calculate Oak Corp's share of earnings from Maple Inc., we need to consider both the common and the preferred shares separately under the equity method. So let's go ahead and figure this out. So first we have to figure out the share of the net income to the common shares. You could actually do these both in any order you want, by the way, because they kind of are exclusive. So first, to figure out how much of the common dividends, the common shares that they're going to receive, we have to figure out how much of the net income is actually available to the common shareholders. So we take the total net income, which was given of $400,000, and we subtract the preferred dividends that were given, So that's $400,000 less $93,500. That's $306,500 of net income that is available to shareholders. And then we can multiply that by Oak Corp's share of the common earnings, which was given to us as 10%. So 10% of $306,500 is $30,650. So that's part of their income there, their revenue that they get from having this investment. And then we go down to the preferred dividends. Oak Corp owns 30% of the preferred shares, so it is entitled to 30% of the preferred dividends declared and paid. So that means $93,500, this one that's right here, multiply that by 30%, and that gives you $28,050. So add those two together, and that gives you $58,700 of total earnings from having these investments. And so again, even though this video is mainly about figuring out the carrying amount of investments under the equity method, this does seem to be something that you should know. So if you ever see a question about knowing under the equity method how much of the earnings they get from a company, just remember that you have to figure out the net income that is available to the common shareholders, and then their percentage ownership in the common shares is how much they're going to get from that. And then if they have an ownership of the preferred dividends, that one's a lot easier. You just take the preferred dividends that were paid and multiply it by their ownership percentage of the preferred dividends, and that will give you the earnings from the preferred dividends. So again, this is not too difficult right here, but I wanted to throw this last question in. And with that, we've gone over quite a bit in just 5 questions. And before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you're going to notice the things that keep popping up. You're going to see 2, 3, 4 questions trying to teach you how to calculate the carrying amount of equity method investments. You're going to see multiple questions trying to teach you how to calculate the earnings for a company that has investments using the equity method. You're going to see the things that are obviously important instead of just focusing on one question that's only teaching something that is only taught once and you never see it again. You focus on the things that you keep seeing in the questions, and so you know that these are the pillar topics, the important things that you need to know for the exam. So you write down these pillar topics, you summarize them, and as you're doing this every day, you're going to be building this repository of knowledge in your own words of the pillar topics of the things that you've studied each day leading up to the exam, and this will help you kind of know what you need to know for the exam. So with all that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Now, there's only a few here. We're going to talk about each one of them, and then that will be the end. Significant influence and the 20 to 50% rule. This is a big part of the equity method, so you need to make sure you know this. The equity method is used when an investor has significant influence over an investee, typically indicated by ownership of 20 to 50% of voting shares. However, significant influence can also exist with less than 20% ownership if the investor can impact decisions, such as, board representation and things like that. We talked about that in one of the questions. One other thing I want to point out, you may think, well, why is it just 20 to 50%? Wouldn't it be like if they have over 50%, they definitely have significant influence? But actually at that point, if it's over 50%, we're not talking about the equity method anymore. We're talking about acquisitions or consolidations. So that's something totally different. So again, that's why it's 20 to 50% is the general rule, but there can be significant influence outside of that, but not over 50%, but it can be under 20% sometimes potentially. Now, as far as calculating the ending investment balance, this is really not that difficult once you know what it's asking for. To determine the carrying amount of an equity method investment, adjust the initial investment by adding or subtracting the investor's share of the investee's net income or loss, which again, you would be subtracting their portion of the loss if there was a loss, and subtracting dividends received. For partial year investments, prorate the share of net income based on the time the investment was held. And then finally, you may also see this for an equity method question. You sometimes will have to calculate the revenue from the equity method investments. Under the equity method, the investor recognizes its share of the investee's net income as revenue, which is based on the percentage of common shares held. Preferred shares dividends are recognized separately on the investor's share of the preferred dividends declared and paid during the year. So again, the common shares, the preferred shares, they're calculated separately. You can kind of do it in whatever order as long as you know what the preferred dividends were and how much income is available, therefore, to the common shareholders after you take the preferred shares out of the net income. So those were the pillar topics for this video. I hope this was helpful, and before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's free, it is 1 hour, and we will teach you the key ingredients that you need to pass the CPA exam so that you don't waste months or even years of your time failing exams and wasting your money. So make sure you go check that out and sign up for it. It will help you a lot. And also remember that SuperFast CPA Pro members get access to a whole bunch of awesome resources, including the full versions of these videos where I typically go over 10 questions instead of these free 5 questions that we go over in YouTube. So if you want more of this, and if you want access to a whole bunch of other resources, again, make sure you become a SuperfastCPA CPA Pro member, and that will help you a lot with passing the exams as well. Now, if you liked the video, make sure to like it and leave a comment. And with all that said, thanks again for watching, and I will see you in the next video.